Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mike Reynolds, Vice President of Investment Strategy over at Glenmede, to discuss the rise of zombie companies. Mike, it's great to see you as always. Welcome back to Trade Talks.
Happy to be here.
All right, you got it. And the share of serial unprofitable companies known as zombies, they've grown through the pandemic recession to near multi-decade highs. Why do you think that is the case, and how much of the market do they occupy?
Yes, we borrowed this term from the Bank of International Settlements. We're talking about companies that on a consistent basis are not able to cover their interest cost on a 3-year basis by our analysis. This has grown to be approximately 14% on a cash flow basis of companies in the US publicly traded. That being said, they're relatively concentrated in the small cap sector in the US. So as a percentage of market cap, we're looking at something closer to 5% of market cap could be categorized this way.
What sectors do most zombie companies live in, and why do you think that is?
Yeah, so there's some representation across the board on basically all sectors, except utilities has 0 from our current look at it. But they are primarily focused in the biotech space. This makes a lot of sense given the business models that you see in biotechs, where there's a sort of prove that your product will work and then monetize sort of business model. So we continue to see that biotechs have a pretty significant size in the zombie companies. Not necessarily saying that a lot of these biotech companies will fail, but it's just sort of a byproduct of their business.
Speaking of failing, let's talk about zombie companies more holistically. Do all of them fail? And isn't this environment of higher rates and more expensive costs of capital going to make it more difficult for them?
Yeah, sure. So certainly not all zombies fail, and especially those that have a promising product or service that they're able to bring to market pretty successfully and monetize. Those do go on to be profitable companies and to sort of enter the regular pantheon of companies that are just, investable companies. But you do have a fair amount, a lot of these biotech companies you can almost consider like lottery tickets. Their business and their product either works or it doesn't. So a good amount do fail. And it's, whether or not this is an attractive risk-adjusted return to be investing in companies of this on a broad basis is always a question for investors. And we, as a result, tend to be a little bit more deliberative in our analysis of companies in these sectors.
Of course, we have to talk about Silicon Valley Bank. It's on top of mind for investors. Do you think that will impact capital flow and liquidity?
There's a lot of very similar factors going on, and that's sort of sensitivity to interest rates. One of the downfalls of Silicon Valley Bank is they got caught off sides. Rates were going higher, and a significant part of their equity book was longer maturity. This is going to make the cost of capital go higher for a lot of companies across the board. This is not just financial sector. This is all sectors broadly. All else equal, if you have a few companies that are just sort of stringing along and barely covering their costs and issuing new debt, that's going to get harder and harder to continue that process as rates continue to rise and stay high for some time as the Fed is trying to fight inflation pretty hard here.
So what should an investor do to avoid zombie companies? What should they be looking for on balance sheets or within the fundamental story of these companies?
It's particularly important from our perspective to have a quality bias in small cap investing. That means a focus on profitability needs to be a cornerstone of the investment process in this space. You can look at a couple different indices with different methodologies to them. The Russell 2000 index in particular just kind of straight owns the smallest companies. 25% of that index we could categorize as a zombie company at this point in time. Compare that to something like the S&P 600 index, which has a profitability screen to it. Less than 2% are zombie companies by that measure. So a quality bias, much like the S&P 600 index, and any sort of investment process that does something similar with a quality bias is going to make sure that you have access to profitable companies and avoiding those zombies.
All right, Mike, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.